Hello guys and welcome back to our YouTube channel. In this video we are talking about Cathie Wood's urgent warning to stock investors. Before we continue our video, make sure to subscribe to our channel and hit the bell icon for more videos. So let's get started. Cathie Wood is a star stock picker and founder of $60 billion assets, ARK Invest, which invests in innovations like self-driving cars and genomics. After stints at other investment firms, Wood created ARK in 2014 hoping to package active stock portfolios in an ETF format. Her flagship $23 billion assets, Ark Innovation Fund has returned an average of nearly 45% annually over the past 5 years. Wood studied economics at USC under Art Laffer, the inventor of the Laffer Curve, which theorizes the tie between tax rates and tax revenue. Wood is one of the biggest boosters of Elon Musk's Tesla. She predicts the electric car company will someday be valued at over $3 trillion. Cathie Wood is often called the most underrated investor in the game, and for good reason. Not only is she incredibly persuasive in her investment arguments, but she's also got the proven results to back up her surprisingly discerning claims. You see, Cathie Wood was born to 2 Irish immigrants in Los Angeles, California. Thanks in part to an encouraging and supportive father, who always pushed her to make her own discoveries in life, Wood went on to graduate with honors from Notre Dame Academy, and then the University of Southern California with a degree in finance and economics, effectively laying the groundwork for a future career in investment management. That's exactly how Wood became rich, by the way, through the management of ARK Invest, a company that currently boasts over $50 billion in assets under management, AUM. She didn't just end up there overnight though. After college, Wood landed a job as an assistant economist at Capital Group. Thanks to the guidance of her mentor Art Laffer, of the Laffer Curve, Wood was able to put in the time and effort to move up in the world, this time to Jennison Associates, then on to co-found New York-based hedge fund Tupelo Capital Management. Despite many career ups and downs during and after the 2007 to 2008 financial crisis, Wood was able to come out the other side better off than ever as she founded ARK Invest in 2014. When first conceptualizing the central idea behind ARK Invest, Cathie Wood envisioned exchange-traded funds, ETF, that were actively managed and based on disruptive innovation. Initially, she had hoped to float the idea at AllianceBernstein, where she was working at the time. When they hesitated because of the assumed riskiness of the proposal, she decided to leave and do it herself. Thus, ARK Invest was born. From there, Wood has gone on to accrue her impressive net worth, rack up $50 billion in AUM for ARK, and run 2 of the top 10 female-run funds in the United States. Cathie Wood of ARK Invest said Thursday the technology companies in her innovation-focused portfolio are drastically undervalued, and she believes that her fund's recent sell-off is short-lived. "We've had a significant decline," Wood said Thursday on CNBC's halftime report. "We do believe innovation is in the bargain basement territory. Our technology stocks are way undervalued relative to their potential. Give us 5 years, we're running a deep value portfolio." Her flagship fund ARK Innovation ETF was caught in the epicenter of the tech-driven sell-off in 2022, down 26% year-to-date. Some of her big holdings, including Zoom, Teladoc Health, and Roku, have tumbled as much as 70% this year on expectations of rising interest rates. "Our biggest concern is that our investors turn what we believe are temporary losses into permanent losses," Wood said. Higher rates typically punish growth pockets of the market that rely on low rates to borrow for investing in innovation. And their future earnings look less attractive when rates are on the rise. Wood said she doesn't invest in any of those mature big tech companies like Microsoft. ARKK bets on companies in the forefront of disruptive technology in a variety of industries from DNA to automation, robotics, and artificial intelligence. Her top holdings include Tesla, Exact Sciences, UiPath, and Coinbase. Today we have investors doing the opposite of what they did in the late 90s. They are running for the hills. It's a risk-off because of inflation and interest rates. And the hills are their benchmarks. They are running to the past, Wood said. "If we are right and the disruptive innovation that is evolving is going to disintermediate and disrupt the traditional world order, those benchmarks are where the risk is. Not our portfolios," she added. Despite the big underperformance, her ARKK has attracted more than $70 million in net inflows year-to-date, according to FactSet. The innovation investor said she believes the inflationary drag on growth stocks will end ultimately, and that deflationary forces will return. A lot of what's going on is supply chain related, Wood said. I do think the deflationary forces building in the economy are pretty strong. A week ago, famed stock picker Cathie Wood, the CEO of New York City investment firm ARK Invest, doubled down on her staunch bullishness for disruptive technology even while ARK's flagship fund cratered on Thursday, touting formerly high-flying stocks like Zoom and Roblox that have more than halved in value since their pandemic heydays. During CNBC's halftime report on Thursday, Wood said her flagship fund's significant decline has left its portfolio of technology stocks way undervalued relative to its potential, positing that rapid inflation, which has fueled concerns of more hawkish Fed policy and driven investors away from many tech stocks, should ultimately end. Driven by a broad market sell-off, the $16 billion ARK Innovation ETF plummeted as much as 7% Thursday, pushing shares down more than 50% below an all-time high from last January and 30% for the year compared to a nearly 9% decline for the S&P 500. Give us 5 years, Wood said Thursday about the recent losses, adding that her biggest concern is that investors cash out amid the slump and turn what we believe are temporary losses into permanent losses. She specifically defended Zoom video and Gen Z gaming platform Roblox, two portfolio stocks that skyrocketed as much as 700% and 90%, respectively, during the pandemic, but have since plunged more than 60% due to disappointing growth as COVID case counts wane. Wood attributed the disappointing end-of-year results to tough comparisons, based on the firm's explosive growth 1 year earlier, saying Zoom's recently tepid results will likely be the lowest point for growth over the next few years. ARK loaded up on nearly $25 million worth of Roblox on Wednesday, when the firm's stock posted its worst one-day performance on record, tumbling more than 25% after sales, earnings and user growth all fell short of expectations. She said, "If we are right and the disruptive innovation that is evolving is going to disintermediate and disrupt the traditional world order, those benchmarks are where the risk is. Not our portfolios," Wood said Thursday, responding simply absolutely. "We stand by that" when asked to defend recent comments that tech stocks are not in a bubble. A lot of what's going on is supply chain related. I do think the deflationary forces that are building in the economy are pretty strong. Increasingly, Wood's strategy, which ARK says focuses on disruptive innovation, has garnered skepticism on Wall Street. Last month alone, traders betting against ARK's flagship fund gained more than $1 billion, eclipsing their entire haul of $941 million for last year. "The idea of shorting innovation in America is ridiculous," Wood said about the shorts on Thursday. Among her critics, Scion Asset Management, the hedge fund headed by investor Michael Burry, who famously predicted the housing market crash in 2007, disclosed it holds bearish put options on $30 million worth of ARK shares late last year. Technology stocks led the market's rally after a pandemic-induced crash in early 2020, generating massive returns for tech-heavy investors like ARK. Starting last spring, however, accelerating economic growth and the threat of rising interest rates spurred a stock market rotation away from growth stocks, like those in tech, to cyclical and value-leaning slices of the market. That rotation came to a head last month when stocks posted their worst start to a year since the Great Recession. Hope you guys enjoyed our video. Make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a wonderful day.